Listen, I want you to picture something with me. It is a Tuesday evening in late January of 2026. A woman named Patricia, 72 years old, retired elementary school teacher from Lincoln, Nebraska, is sitting at her dining room table with a pile of tax documents spread out in front of her. She has her SSA 1099 from Social Security, her 1099-R from the teacher's pension system, her bank statements showing the interest on her savings account, and a folder of receipts from the year. Patricia is not rich. She never was. She taught second grade for 38 years. She raised 3 kids on a teacher's salary. She has a small pension, Social Security, and about $180,000 in a traditional IRA that she has been carefully drawing down since she retired at 67. Every year, she does her taxes with the same online software she has used for a decade. The software asks her questions. She answers them honestly. The software calculates her refund. She files, she gets her money. End of story. But here is what Patricia does not know. There are 7 tax credits, 7 specific, legal, congressionally authorized tax credits that are designed for people exactly like her, people over 65, people with retirement income, people who care for grandchildren, people who made energy improvements to their home, people who are still contributing to retirement accounts. Even part-time, Patricia qualifies for at least 4 of them. She has never claimed a single one. The combined value of the credits she is leaving on the table, approximately $7,500 per year. For 7 years of retirement, that is over $50,000 in money that belonged to her and went to the IRS instead. If you are new here, I am so glad you found us. We talk about the money rules they do not put in the retirement brochures, the tax breaks designed for people like you that nobody bothers to mention. Today, we are going to walk through 7 specific tax credits that seniors miss every single April. Some of them are new for 2026, some have been on the books for years, but almost nobody claims them. All of them are legal, and all of them require nothing more than filling out the right form. Let us start with the biggest one. Credit number 1 is the newest and the largest. It was created by the One Big Beautiful Bill Act, and it is a brand new tax credit specifically for taxpayers over age 65. The maximum credit is $7,500 per year, and it is available through 2028. Let me be clear about what this means. This is not a deduction. A deduction reduces your taxable income. A credit reduces your tax bill dollar for dollar. A $7,500 credit means you pay $7,500 less in federal income tax. If your tax bill is $5,000, the credit eliminates it entirely and you get the remaining $2,500 as a refund. The income limits and eligibility rules are specific, and they vary depending on your filing status and your state of residence. This credit is means tested, meaning it is designed for middle income and lower income seniors. But the cutoff is higher than most people assume. If this credit applies to you, you can claim it for the current tax year. And if you qualified in 2025 but did not claim it because you did not know it existed, you can file an amended return and get that money back. The IRS has 3 years from the original filing date to accept amended returns. Credit number 2 is the Saver S credit, also known as the Retirement Savings Contributions Credit. Its official IRS name is Form 8880. Here is what most retirees get wrong about this credit. They think it is only for young people. They think once you are retired, you no longer qualify for a retirement savings credit. That is wrong. If you are still working part-time in retirement, and a growing number of retirees and you are contributing to a retirement account like an IRA or a 401k, you may qualify. The credit is worth up to $1,000 for single filers and $2,000 for married couples filing jointly. For 2026, the income limits are approximately $39,000 for married couples filing jointly and $19,500 for single filers. If your income falls below these thresholds and you are making retirement contributions, you qualify. Here is the real opportunity. Many retirees work part-time, earn $15,000 from a part-time job, and contribute $2,000 of that to an IRA. The Saver S credit gives them back up to $1,000 of that $2,000. That is a 50% return on their contribution. Instantly, if you have earned income from any source in retirement and you contribute any amount to an IRA, fill out Form 8880. It takes 10 minutes. Credit number 3 is not a federal credit. It is a state-level credit, and it varies wildly depending on where you live. But for retirees in the right states, it is worth thousands of dollars per year. Multiple states offer property tax credits or rebates specifically for seniors. Missouri has a property tax credit for seniors with income under $30,000. Wisconsin offers the homestead credit. New York has the senior citizens exemption, which reduces the assessed value of your home by up to 50% for tax purposes. Massachusetts has the senior circuit breaker tax credit, which gives you a credit against your state income tax for property taxes or rent that exceed 10% of your income. The problem is that these credits are not advertised. You will not get a letter from your state saying you may be eligible. You have to know to search for Senior Property Tax Credit, plus your state name. Check your state revenue department website. Even if you do not owe state income tax, some states will send you a refund check for the credit. Credit number 4 is the Energy Efficiency Home Improvement credit, expanded significantly by the Inflation Reduction Act. If you made energy-efficient improvements to your home in the last year, you may qualify for a federal tax credit of up to 30% of the cost. Exterior doors qualify for up to $250 each. Windows and skylights up to $600 total. Insulation and air sealing have no dollar limit at 30% of cost. Heat pumps and heat pump water heaters qualify for up to $2,000. Solar electric panels qualify for 30% of cost with no upper limit. For retirees, this is particularly valuable because many retirees own their homes and are aging in place. If you replaced old windows or installed a heat pump, that qualifies. Keep the receipts and manufacturer certifications. Ask your tax preparer about Form 5695, the Residential Energy Credits Form. Credit number 5 is one of the most overlooked credits in the entire tax code. It has been on the books for decades. Almost nobody claims it. The IRS calls it the credit for the elderly or the disabled. It is found in IRS Schedule R. To qualify, your adjusted gross income must be below $17,500 for single filers or $25,000 for married couples filing jointly. Your non-taxable Social Security and pension income must also fall below certain thresholds. If your income is below those thresholds, this credit can be worth up to $3,750 for a married couple filing jointly. Why do so few people claim it? Because tax software does not ask about it automatically. Because many tax preparers do not think to mention it. Ask your tax preparer about Schedule R. Even $500 to $1,000 is real money. Credit number 6 is the Child and Dependent Care Credit. And yes, it applies to retirees who care for grandchildren. Approximately 2.7 million grandparents are raising their grandchildren in the United States. If you are one of them and you pay for childcare, summer camps, or after-school programs, you may qualify. The credit covers up to 35% of qualifying care expenses, up to $3,000 for one dependent or $6,000 for two or more. The dependent must live with you for more than half the year. The care must enable you to work or look for work. If you are retired but caring for grandchildren so your adult child can work, and you have some earned income, the care expenses you paid may qualify. Track every dollar. Ask for receipts. Form 2441. Credit number 7 is the Earned Income Tax Credit, one of the largest anti-poverty programs in the federal tax code. Most retirees assume they do not qualify. They are wrong. To qualify, you need earned income from a job or self-employment. You also need to be below certain income limits for seniors. Without qualifying children, the limit is approximately $18,000. The credit is smaller, up to about $600, but it is refundable, meaning if your tax bill is zero, the IRS sends you a check. If you have any earned income, do not assume you are too old to qualify. Use the IRS EIT Assistant tool on IRS.gov. It takes less than 5 minutes. Let us go back to Patricia, the retired teacher from Lincoln, Nebraska. In 2025, Patricia had an adjusted gross income of approximately $34,000. She received $18,000 in Social Security, a $12,000 teacher's pension, and $4,000 in withdrawals from her traditional IRA. Here is what she left on the table. Credit number 1, the new senior tax credit, Patricia. S income is within range, estimated value $3,500. Credit number 5, the credit for the elderly or the disabled. Her adjusted gross income is close to the threshold, but because Social Security is only partially taxable, she qualifies. Estimated value $1,200. Credit number 3, Nebraska has a property tax credit for seniors with income under $32,000. With some adjustments, Patricia might qualify. Estimated value $400, 7 years of retirement, an estimated $5,100 per year in unclaimed credits, over $35,000 in total. That is not a small mistake. That is real money for a retired teacher on a fixed income. Here is what I want you to do. 1. Review your last 3 years of tax returns. Do you see any of these 7 credits? If not, you may have missed money. 2. If you think you qualified for a credit in a prior year, file Form 1040X, the amended return. The IRS accepts amendments within 3 years of the original filing. 3. Print out a list of these 7 credits and take it to your tax preparer. Ask them directly, am I eligible for any of these? If they brush you off, find a new preparer. 4. If you use tax software, do not just answer the questions it asks. Tax software is optimized to be fast, not thorough. You have to know to look for niche credits yourself. 5. For state level credits, search specifically for your state's senior tax credit programs. The information is public. It is just not advertised. These credits exist because Congress intended them to exist. They are not loopholes. They are not tricks. They are specific policy decisions designed to help older Americans keep more of their money. But between complex tax forms, software that prioritizes speed over completeness, and preparers who do not always ask the right questions, Billions of dollars in senior tax credits go unclaimed every single year. The IRS is not going to send you a letter saying you missed a credit. That is not their job. The money is yours, but only if you know to ask for it. That is all for today. Thank you for watching.